excited today to have our speakers, Carleen Broomfield and Bill Lockington, to talk to us about estate planning. It might be a difficult topic, but I'm just excited to learn more, and I'm a planner, so I like to plan things and know what's going on. Can people in Zoom hear us okay? So we have about more than 23 people joining us on Zoom, and we have about more than 35 of us here in this building. Oh yes, Yvonne is, okay, it sounds good. All right, thank you so much. So Yvonne is helping us to monitor the Zoom, to admit people in, and Janine is helping to monitor the chat to see if people have any questions, and we'll ask during the Q&A. And so please forgive us. We make any mistakes today because it's the first time we're doing this workshop. It's a bit chaotic at the beginning, but I'm glad everyone's here. I just want to go over our agenda for today. So there's some light refreshment here. Feel free to get some at the end. And Leah will help us with land acknowledgement. And the washroom is just over there, just down this hallway. There's a sign that says washroom. So there's two washrooms there if you need it. And Carleen will, after that, will talk to us about the consequences of not having an estate plan. Then please hold your questions until the end of her presentation, because some of your questions might be answered during her speech. And then after that, Bill will talk about taxes, and we'll miss basket. And after that will be a Q&A session for Bill, and then feel free to ask any more questions and talk to each other and have some more refreshing. Is that all good? Did I miss anything? All right, thank you. So I'll give this over to Leah.
Okay, hello, good afternoon, everybody. So just before we get started, we want to respectfully acknowledge that we are on the treaty and traditional territory of Mississauga and Anishinaabe. I am both, my background is settler and also Mohawk. And so being a naturalized Canadian, working with newcomers, part of my work, or what I like to include, is making sure to provide a space where we can learn about Indigenous history, we can celebrate it. And so currently I'm running the newcomer leadership group, and what I have planned for our land acknowledgement later today is just learning a little bit about Thelma Shalafu. She was the first Indigenous woman and first Métis person appointed to the Canadian Senate. Her work within the community was really inspired by her strike when she had her two children taken away during the 60s scoop. If you don't know about that part of Canadian history, I would strongly recommend looking it up. But she is responsible for setting up the Department Métis Association Welfare and Land Departments, and she co-founded the Native Friendship Center and ran the first shelter for women fleeing domestic violence. And in 1997, she was appointed to the Senate, where she focused on issues including Métis housing, the environment, and relationship between pharmaceutical companies and the government. And so I just want to hold this place to really bolster the amazing work that she did for Canadian and the Métis communities. Thank you.
Thank you so much, Leah, for the land acknowledgement. That's really great that we learned something new from each land acknowledgement. Awesome. Okay, so I want to introduce Carleen. She's the financial advisor. Before that, before life, she was working for the government, right? And she knows a lot about social work, and she also can sing, but that's another presentation.
Thank you, Paris. And, oh, we do, yes, very nice. So it is a pleasure to be here with you all who are in person and those who are online. Again, my name is Carleen Broomfield, and I am a financial advisor. Did I go? There we go. So I'm an independent advisor. The firm that I work with is called Experior Financial Group. And as an independent advisor, what that means is that I work for myself, but I am also a broker, right? So that I have access to plethora of resources that are going to meet the needs of the person that I'm with. So today I'm here in that capacity, but to sit right before you, answer any questions, and just give you some topics that we can really broach later. So today we're talking about the consequences of having no estate plan. Now, what I want to go into initially is just breaking down what is an estate, because I think when we're talking amongst professionals, it's easy to have a conversation, but speaking with you, I'd like to break down some of that jargon. So what an estate would really qualify is, a good way of looking at it is, what are your assets? And assets are anything that you own, really. So you would calculate it by using your assets minus your liabilities. Liabilities are your debt responsibilities. So mortgages, loans, credit cards, student loans, any loans that you have to family, non-registered loans, those sorts of things. So you would take the assets, the value of those, like your house, your bank accounts, savings accounts, checkings accounts, TFSAs, pensions, RSPs, boats, cottages. Take the values of those things as best as you can possibly calculate them, subtract your liabilities, and there you would have the value of your estate. Why that's important? It could be for many reasons when you're looking at your taxes, tax consequences, and it's a good thing for you to know. So your assets are anything you own when you die is really how you would identify what that is. And then it does not include joint assets. So if you're married or you're common law or not, you may have joint accounts with parents and such like those. In those scenarios, you would not count those accounts or products as an asset. And disposition of an asset is something you would manage by a will and estate laws, which is what Bill is really going to address for you guys today. Right? So now that we know what the estate is, I wanted to talk to you guys about a concept that I break down with my clients, and it's the wall of death. It's not a very inviting conversation, but we're going to go through it really briefly. So this is what would happen when you pass away. Many of us, we don't know what happens when we die and what we need to be responsible for and how to plan for that. So here we have an arrow that's pointing towards life. We have a beginning, and we all have a predestined time of death. So we meet that wall, okay? So what happens when somebody passes away? There's a process called deemed disposition that you can see here in this box. The deemed disposition is when the government assumes that you have, as soon as you pass away, as per the date that is given from medical professionals, they deem that you would have disposed of, you would have sold those assets that we talked about. So like registered products, your RRSPs, your pensions, as soon as you pass away, even a house, they would assume that you sold that asset. You would not have sold it, but they would assume that. So why is that important for them? They're going to use it to calculate what is the value of your estate. So they take you through a crystallization process. So they freeze your assets, so to speak, and they use it to calculate a value on what the net worth of your assets would be. And then what happens after that deemed disposition and the crystallization, there are two people that come after your assets. It's going to be the creditors. I don't have a pointer, but there's creditors. So your mortgage company, your credit card companies, any loans that you have, those creditors would be coming with the expectation that they get a piece of that your net worth or what's owed to them that would be coming from your deemed disposition and your net worth. Then also there's the taxman, CRA, right? So the CRA would now also be, you have to file terminal tax return. You now owe a piece of your assets to the credit, to CRA. Does that make sense to those here? Okay. So when you're filing your terminal tax return, and Bill's going to go into this in more detail, what do you need to include? So the principal residence is a part of your net worth, but it's not taxed. Principal residence that you live in primarily. And so that's just one property, right? Then you have capital property that's also included in the deemed disposition. Now, capital property are things like shares, rental properties, or vacation properties. Those things are taxed at 50%. So you would take whatever the value is in the current day market, the full value of it, and they would tax that at 50%. Then you also have registered property that's taxed 100% at marginal tax rate. So things like people have RRSPs or pensions or RIFs, depending on where you're at. Those things, that money in that asset is now going to be deemed as it's unregistered, and they tax it at 100%. So if you have, depending on where you're at, 100,000 or 200,000 sitting in a pension, that's and you're not married, then it's unrolled, unregistered, and they tax that. That would be added to your terminal tax returns. Then there's any cash or near cash. So that's like your TFSAs or GICs or cash that you actually have. So when you pass away, that deemed disposition, this is a part of what's attributed under a cost of dying. People don't think about, well, when you pass away, this is a mess that is just passed on to somebody else. But there is a cost to passing away, and that's some of the costs that you would have to face, and you have to make sure that there's money available to pay those taxes and to pay those creditors. And if you don't have that money, the question is, how do you pay it? Some people think, okay, well, I have a house, then that house, my family can just sell the house and give the value of whatever is needed to the CRA. But there's scenarios or situations that you can't really plan for. If you have a house that you want to sell and you have to dispose of it because you don't have any money available to pay the CRA, your estate at least, you know, the thoughts that you have to think is, are you going to get the value for the house that you desire, right? Or that you would think that it is valued at the time of your passing? Most likely not. Usually the people who are going to be managing the disposition of this property, they're under stress, right? They're grieving. They don't want to manage those kind of things. There's a financial and an emotional cost of passing away that we need to think about as we're going on, right? And that we want to plan for. So now we talked about what's in your estate, right? The ways that you can pass on what's in your estate is through the will and through the probate process, which Bill will go into. So when you go through the will and the probating process, there's time. There's a time quotient that we need to think about. It doesn't just happen right away that you can pass on the assets or pass on the things that are in your estate. It has to go through the courts. There's also a cost associated to filing, and there's a cost that you need to think about when we're going through probate, which also people don't think about. And how do you pay for the probate process? So really, when you're passing on valuables in your estate, there's time you want to think about, there's cost, there's the financial costs. Usually you want those things to just be able to flow naturally through to your family, to your beneficiaries, which could be your spouse, children, grandchildren, and you think it's going to happen immediately. But here what I'm showing you is it doesn't usually, I think, and Bill can correct me if I'm wrong, but right now in Ontario, the probating process to get completed should be about 6 months or so, it depends. But it can take some time. So remember, there's costs that you have to pay immediately, the tax bill, your creditors, they want those things right away. But how did your family get access to any money to be able to pay for those things? And then how does your assets flow or do they flow naturally or seamlessly to your family as you would want them to? These are some of the things we want to think about when you're sitting down with a financial advisor and doing your estate planning. Is how is that going to happen? How is that flow process going to look? Is it going to be easy? Now, usually what people would want to do is, because you can't, because of the time process and because of the cost to flow your assets through going through a will, oftentimes the easiest way to manage or to avoid any of that is to have proper life insurance in place and having segregated funds. And we talk about how segregated funds can be useful for you, and in the estate planning process, it just makes it a lot easier, a lot quicker, and it's outside of your will, which is what this diagram is showing. If the asset is outside of your will, it's not going through the probating process, it often can flow through a little quicker to your family. And this situation may not be ideal for everybody. So what I want to say is estate planning, it of course, and what I was alluding to, is it refers to managing how your assets are transferred to your beneficiaries when you pass away. That's what estate planning is. It is required to make sure that you have a say, right? You've worked so hard in life, ideally, you've worked really hard in life to acquire all these assets and to make proper connections, and to have an estate, a mountain of an estate, or even a little mountain of estates. All of them are important. It's yours. It's valuable to you. And so ideally what you want to do is, why estate planning is important for everyone, is because you want to have a say in life, what happens to your valuables and how it's treated after death. After death, you have no say, right? And so the estate planning process is important for anyone, for everyone. So elements of a financial plan, and why I want to talk about this is because estate planning is only one piece in the financial plan. We're focusing on it today, but it's just one piece of a financial plan. I wanted to bring to you a holistic view of what it's a part of, how it's important, and it's usually like the last part of a financial plan. So everyone should have a financial plan, and a good financial plan, because some people say they have one, they don't realize, what is a financial plan? So I'm not sure why it looks a little. Let's try go back. Are you seeing it clearly up there? It looks a little pixelated on mine. Okay. I may have to come down there then. Oh no, then you won't see me.
Oh, it's pixelated on. Oh, I will share the slide after.
Okay, so a good financial plan talks about how you earn income. When you sit down with a financial advisor like myself, and there's a lot of financial advisors out there, I'm not gonna lie. You can talk to one and they could be great, they could be horrible. But how you know what is gonna make a good financial advisor, and if you're sitting with the right person, is, first of all, they should be giving you, I don't think it should cost you to sit down with one. Number one, it doesn't have to be a cost to you. We have people in our society that we have people who are doing well, people who are working their way towards, and they can afford to sit down with someone. They may be considered somebody of like a high net worth. They make a lot of money, and so they can sit with a financial advisor who charges them per hour or whatever to manage their assets. But there are agencies out there who won't sit with you unless you have a certain amount of money sitting in a bank, right? That's not fair. So I'm a financial advisor who meets with and can talk to anybody, no matter what walk of life or where you are in your planning or your success levels. It doesn't matter. I'm fully available and willing to talk to you, and there's no cost to do that because it's your life. This is like very much like going into a doctor's office and trying to get a diagnosis for what your condition is. You sit down with the doctor, you tell them what your concerns are, they diagnose it, and they give you a recommendation, which is medical language, a prescription, and you walk out and you fulfill right? There's no money exchanging hands there necessarily. So when you're meeting with me, I will sit down, we talk about your earning capacity. I really do need to see that screen. So we talk about your cash flow. Where is your money coming? Where is it coming? Where is it going? Kind of thing. We also talk about having an emergency fund. So we're not looking at just helping you spend money wisely. We also make sure that you have emergency funds for, thank you, for when it is, for when things go wrong, right? Like we experienced COVID, there was a lot of people who didn't have proper emergency planning. I can't really go through everything in detail right now, but some of the elements of a good emergency fund is like at least 3 to 6, for the majority, 3 to 6 months worth of your net income, which is after tax income, you should have in a liquid account, an account you can go in and you can access at any point in time, right? We talk about consolidating debt. We talk about using income efficiently so that you have the financial management piece is what we go into. Then we also have the risk management. I would ask, can anybody tell me what is their biggest asset? Raise a hand. Does anybody know what your biggest asset could possibly be? Yes. You shouldn't be allowed to answer. So she said yourself, and that's very true, because if you and your intellectual capacities, you didn't have, you know, your ability to think, your ability to walk, you know, your ability to go out there and make an income, there goes your cash flow, there goes your income creating ability, right? So we have to make sure that we protect, number one, you, if something goes wrong to you, that your level of income, the quality of life that you now have is not going to be impacted. So we talk about having the proper protection against loss of income. Not only loss of income for you, but if you have a family, if you didn't come home tomorrow, what would happen to your family? If you have children in the room, what would happen to them? How would their quality of life change if your income is no longer there, right? We also talk about protecting your family assets and settling funeral and final expenses most tax efficiently. That's really good. Sitting down with a financial advisor who can talk about all of those things, explaining your expenses and talking about final expense planning, but how do they address the tax and being tax efficient? That's very good, right? With the tax planning, sorry. So tax planning, asset management. So we want to preserve your assets. We also want to make sure that we grow your assets. So preserve it, we can grow it. And sorry, I want to get you on the same page with me here. Coming a little slower than I expected, but that's all right. We're going to get there, guys. And I think there's one more supposed to show. Is it showing on yours? So we have financial management, risk management, tax planning, asset management. So we preserve your assets. There it is. Grow your assets. We want to create income for you. For the most part, creating income is the responsibility is going to be on you. But sitting down with a financial advisor, they can talk about income creating opportunities. And then as well, minimizing taxes is always going to be a part of this process. And then retirement planning. So establishing what's called your financial or your financial independence number. And a financial independence number means when you're retirement planning, understanding, okay, what you're working towards. We have a GPS. If you're heading towards a certain direction, you tabulate the address in, and then it spits out the directions, right? Your FIN number is very much like using your GPS. You know, okay, I want to retire by age 65 or even 60. Okay, Sitting down with me, I would be able to tabulate what are the steps that are going to help you get there. How much income do you actually need in order to be able to retire by age 65? And how do we establish that? How much do we save every month to be able to do that? That's something that you sit down and do with your financial advisor. Or the right financial advisor. And then as well, using the appropriate financial vehicles to accomplish your FIN number. So, just making an income, getting an employment income is not the only avenue or not the only way for you to be able to get to your retirement plan, your retirement age successfully. You can also sit down and work with an advisor to use proper asset planning. So getting a TFSA, making sure that it's invested correctly, knowing what's, for example, called the Law of 72 and how that would apply to you to help just get you there at a little more of a faster pace to where you want to be, and knowing, what kind of rates of return your advisor can get for you, and helping you understand investing a little bit more. And then estate planning. So estate planning, again, you see it's the last piece here. And that means making sure that you're building a family legacy. So everything that you're working towards today, it is valuable no matter what stage you're at. And just making sure you're setting up proper structure so that when you do pass away, that it is being passed on in the way that you had initially intended for that to happen. Or if you're already in the family stage and you have children, are your assets, if you passed away again tomorrow, what would happen to those assets? Would your children be okay? Or would a mess happen? And we definitely don't want to have a mess happening. So the next piece is what a financial house looks like. A financial house is doing an expert financial analysis. And again, this, you should sit down with a financial advisor and not have to pay for it. So sitting down with me, for example, I would ask you a few questions and we will build a house together, right? So you know that when you sit down and, for example, if you're going to buy a house or you're at that stage, you sit with a contractor, you need to have plans, right? Blueprints to the house. You kind of want to make sure it has good foundation. So when we're building a financial house, that's exactly how we start. We make sure that there's proper foundation. Everything that you do today is setting some sort of foundation. Is it a weak one or a good one? I'm not too sure. We would have to go through that together. So we would start with at the bottom, making sure you have proper protection. That's risk management. Okay, we're avoiding risk, loss of income, whether you get ill, or you get a diagnosis of some sort that disallows you from being able to work. We want to make sure your income is protected. So if in case you have to go off work, you can still have some form of income coming in, or if you were to pass away, that your family would be okay. Then we look at a debt elimination, because when you're working and you have a lot of debt, you would agree that it's like a cancer, right? The money that you're making on a paycheck is just going towards somebody else, and you're not seeing any of it. It's not staying, right? So we want to make sure we eliminate debt as quickly as possible and save some of that interest that you wouldn't necessarily be paying out. We want to see it being retained. And then when that elimination of debt is successful, we can now talk about having great conversations about investing and saving. And that's where we're working on putting a roof on your house. Where you can go on vacations when you want, you can live anywhere you want, you can accomplish those goals and dreams. So having a financial house looks like starting at the bottom and going to the top, right? We don't start with having goals and dreams and go down. It doesn't work that way. That's kind of counterintuitive. All right, so tax advantage, I kind of want to leave that to Bill because I think I know he's going to do a great job. But when you're talking about saving on taxes, there are a lot of tax brackets in Canada. I would argue that one of the most. We are taxed very heavily, and working with an advisor will help you, if you have the right one on your team, will help you to be a little bit more efficient in saving. For example, I believe the top tax bracket right now, 53.8% of your income. would, or 53 point something, would be taxed and going towards the government. I don't know who loves the CRA enough to give them more than half of their income. But that's never the intention. But if you sit down with the right advisor, we can talk about how to retain, how to be a little bit more tax efficient. We don't want to evade taxes, that's illegal. But working with an advisor will help to make sure that you are efficient in retaining more of the money that you've been working so hard for, to retain it and keep it in your pocket. And there's just savvy ways of doing it that I could definitely share with you, and that a financial advisor would be happy to do that for you. And one of those strategies would be tax charitable and planned giving. Charitable and planned giving is very important. Thank you, Paris. It's a very key strategy for being able to retain some of the income that you've made within your estate. And the information is there for you. But for example, if you're doing charitable tax credits, you don't see those you don't see those tax credits. I mean, if you're donating, that's part of being tax efficient. But when we're talking about charitable planned giving, generally these tax credits you will see, or your estate will see when you pass away. So remember when I did the wall of death, if you recall, I had life, death, the CRA, and your creditors are two of the people that are going to be coming and knocking at your executor's door. If you do have a will, they're going to be looking for a payout, right? So you can reduce some of that tax bill that would be going to the CRA by choosing to do and be engaged in charitable giving, where your estate would see a tax credit coming back, and some of the estate would be maintained. So charitable and tax planned giving is a very good strategy for people to look into. And again, it's not for everybody, but it's something that is a great strategy to be used, and I do use a lot with my clients specifically. So here it ends the presentation that I have for you today. The next slide would be my information. Oh, there we go. I probably wasn't pointing it. So my name again, Carleen Broomfield. My number is there, and I believe you will find some information to contact me later on. If you do wish to have a complimentary hour for me to just give you a second opinion on what you do have, I'm more than happy to do that. We can sit down through a Zoom meeting and I review what you have, and I will just let you know what you need to be concerned on. And if I can help you, I will definitely do that. So I'm happy to have served you guys today. Was that in time? Oh, you're right. All right. So I think now we have time for questions.
For people in the room here?
Sure. Repeat. Got it. Go ahead. Yes. Okay, so we had a gentleman, I'm sorry, what's your name? Dennis. So Dennis asked the question of how to be a little bit more tax efficient, very broadly giving details of what some of those examples are. So the one specific one that I did give was the charitable giving, but in life is what I'm assuming is what you want to know, right? Okay. So if I was sitting with you, we would go through your financial information. I would go into detail about what is your expenses? What does that look like? We kind of start there. I look at your paychecks, all the sources of income that you have coming in, because I want to know exactly, first of all, are you in the right, is the right amount of taxes coming off? And I'm going to preface this by saying you definitely want to work in tandem with your accountant. Accountants are great at, I mean, they know taxes. They just don't know all the strategies and some of the concepts that I have that can help you be a little bit more tax efficient. But knowing I'm going to share this with you. Let's say, Dennis, there are 5 tax shelters in Canada. Well, it was 4, but they added a 5th one. Do you know what those are? No. Okay. This is going to be helpful. So number 1 is the lottery. I do not endorse that. I'm going to say that publicly. But the lottery is one of the tax shelters. Your primary residence is the second one. The your TFSA is the other one. Well, how many did I give you already? So lottery, the TFSA, your primary residence, the new FHSA is one of them. That's the 5th one that I wanted to talk about, because that could be considered depends. Oh, the first home savings account is the FHSA that newly became, so these are for new home buyers. So if you've never had a home before, the government has introduced this new account that allows you to save up to $40,000, I believe, over 15 years, towards being able to use that money. It stays in the account. It works like a TFSA, so you can use that account and be able to save tax sheltered money and withdraw it without tax consequence towards the purchase or any costs related to buying a new home. So knowing what those tax shelters are, use them and maximize them. That's what I'm going to say. Go ahead, sir. RRSP, so it's a tax deferral, not a tax shelter, because eventually when you do get to your retirement age at 71 and you convert it into a RIF, it is going to be taxed, but ideally you would be in a lower tax bracket, so you can withdraw just at a lesser tax rate. But then also another strategy, I mean, if you're a high income earner, there's like tax splitting, so you can split using spousal RSP accounts. If you have a spouse who earns less than you do and you want to, share some of the income with them, so you can open a spousal RSP. And so there's just many strategies. It really just depends on who I'm sitting with and which arsenal I need to pull out. Oh, registered retirement income fund. So an RRSP, registered retirement, sorry. Thank you for letting me know. Sometimes it just happens, the jargon comes out. But RRSP, Registered Retirement Savings Plan, is what you open, and you can have more than one, by the way. So you can open that, you save towards your retirement. And then when you get to age 71, the year that you are age 71, you do need to convert that into what's called the Registered Retirement Income Fund, where it's unlocking you're able to withdraw funds from your registered retirement savings plan. And you need to do a certain amount every year. Yes, yeah, upon withdrawing. So she asked me, what is a RIF? I explained that. And do you need to pay taxes when you're taking it out of the RIF? And yes, within the guidelines. 71, yeah. Dennis, go ahead.
Let's say
Absolutely. So my memory can be horrible at times. So Dennis asked, what's the difference between a tax-free savings account, TFSA, and an FHSA, the first home savings account? And is there benefit really to having both of them? Did I capture that? Okay. So yes, there is. There is a lot of difference between the TFSA and the FHSA. So the TFSA, any contributions you put into the TFSA, it's sheltered. Any growth in that account is sheltered from having to pay tax. So you can take it out tax-free. But any contribution you make to the TFSA is not tax deductible, meaning you can't use it to reduce your taxes. Did you capture that? Okay. So with the FHSA, it's a tongue twister sometimes. The benefit is that when if you are looking to purchase a home It's just now another vehicle that you can use to grow money tax-free to do that. So the idea is you want to get with an advisor who has access to the resources that you can use to invest and grow that money, because you can have an FHSA. I mean, I believe you, like the major banks, TD, RBC, they have these accounts. At this time, I think some of them are frozen. I'm not too sure why, some of them. But you could just open like a general high interest savings account and throw your money into an FHSA. Now that is, I mean, for the most part, if it doesn't fit your timeline, your time horizon, if you're looking to purchase in the next like month, okay, sure, do that, right? But if you are looking to really buckle down and purchase a house in the next 15 years, you have time on your side to invest. And there is an equation or a formula for making wealth. Can't get into all of that today, but there is a formula for making wealth. One of that is you want to own high value businesses. High value businesses. So some people, you have these fly by night, and we can get into this conversation all day, but you have these conversations where people want to invest in Bitcoin and all this, you know, like they're day traders and whatever. They're trying to make a quick dollar, right? That's nice and lovely. But history shows, the research shows that making money and wealth is only established by owning high quality businesses. You will research, and you will research, and you will find that is one statement that is going to be true. Any wealthy millionaire, they own high quality businesses, or they look to have it. You can have direct holdings on it, or you can, I don't know, go and create your own business, corporations, different conversation, right? But so I kind of veered off on the question. So the FHSA is valuable because you can contribute into that account, grow your wealth, and sorry, yes, I know, I found my mind, is to power and couple with an agent or an advisor who can help you grow that prudently and quickly and efficiently. But you also, every contribution, you can reduce your taxes. So it's good, and you should do it. Even if you don't, having a house is not in your time horizon, you're like, oh my gosh, I can never, with these house prices, it's ridiculous. Do it, because you just don't know. Like I worked with a clients that I've been working with them for 2 years. They were not thinking of buying a house for maybe 5 to 10 years was their time horizon. They're buying this year, right? It just makes sense for them. And they had the FHSA just for a little bit, but they were still able to contribute just really quickly because there's no penalties to withdraw. When you put in to the FHSA, there's no required time that it needs to stay there in order for you to still be eligible for a tax refund. Does that make sense? Yeah, go ahead and do it. Absolutely. Sorry. So he said, Dennis asked if he wanted to buy a house within the next year, does it make sense to go ahead and put money in an FHSA? Yes. Yes. Yes, it does. Go ahead. I think Andy had a question. Go ahead. FIN number. Right, I can answer that quickly. FIN number means your financial independence number. So it's the number, like you have your PIN number, you know, on your bank card. It's just an acronym that means it's the number, the amount of money that you need to have saved in order for you to retire the way that you would like to. So let's say you and I would sit down, I would do a dream map for you, a retirement dream map, and I'd say, what's your name? Helena. I would say, okay, tell me what you want your retirement to look like. Okay, because this is your dream, this is your vision, you're allowed to do that. Now, it's my job to now help you get there. So you tell me what you want your life to look like. We kind of do some quick numbers and figure out how much is this life going to cost you. And then I reverse engineer it, meaning we go back a few steps and we establish attainable goals that you can meet that will help you to save that amount of money. So let's say in today's economy, you need a lot of money nowadays to retire, right? With the inflation rates. But let's say it's like $5 million to retire in the next 5 years. Okay, I help you build a plan that's going to help you to attain that $5 million. It may mean you putting money away every month, which everybody should be doing every week or whatever. Investing yourself into a plan that's going to help you with a future goal in mind of having retirement, if that makes sense. Does that explain? Thank you, Helena.
And the question, can you contribute to a child FHSA to help your child save?
Okay, that's a good question. The answer is no. You have to be 18. Sorry, the question was, can you contribute to an FHSA for a child? You raise a really good point. Thank you for asking that. Unfortunately, no, you can't open an FHSA until you're 18 years and older. However, I mean, if you there's ways to get around that. Number one, I would say start with an RESP. An RESP is a registered education savings plan. Every child should have one because every contribution you make, you see governments contributing some Canada Learning bonds of about 20% of your contribution every year. So that's, if you're not doing it, then that's free money that is going out the window. And again, I would say within what I do, I work outside of the banks. I mean, we are competitors, so to speak. That is for the mainstream, for the people who don't really care or don't really want to know more. But if you work with a financial advisor, you can get and invest in an RESP for your children that is going to meet your investment style, so that you can help get that to that goal a little quicker. You have these organizations like Knowledge First and things out there. Those are group plans, and meeting with you in person, we can have a conversation about why those are not great ideas, but definitely start at the RESP for a child first before even looking at the FHSA. Thank you. Okay, so I think the question Helena has is, can you have the RESP and use it for anything other than education? Okay, so you can open up, and every parent should open up that account. Whether or not an RESP can stay open for until the child is, I believe, 35 years old. So it can stay open for a while. People are allowed to make decisions and have bad chapters in their life, and then they decide, right, that they want to go back and they want to attend publics or get some sort of education. So the money can stay there, number one, for a while before that account is closed. If it's not used for education, it has to be collapsed. It will be collapsed into the owner, which is the parent or the grandparents, because anybody, I mean, as long as you have a direct link to that child or financial relationship or ownership on that child of some sort, then you can have like a grandparent, an aunt, an uncle. They can open an RESP. And if the child doesn't use it for education, it goes into the owner's RRSP. And the loans, or sorry, the grants the government gave would go back to the government, right? So you don't lose the money. It's not lost. The grants are, but I mean, that makes sense.
So, first I'm going to ask, can you hear me all right? Is there anybody can't hear me? I'm not a big fan of these, but people tell me that my voice throws or they don't want to hear it. But anyway, my name is Bill Lockington. I'm a lawyer. I've been practicing longer than I'm going to let you know. And the focus of my practice currently is in the area of estate planning and estate administration. And the reason for that is that when I first started to practice, my clients were the same age as I was. And I particularly had an interest in small businesses, small business development. And as my clients were successful in those businesses, we grew together. And we're now at the point where a lot of the wealth that's been accumulated, and Carleen's been very good telling you how we're going to accumulate that wealth for each of you. But we're now at the point where wealth transfer is a big business. There will be trillions of dollars being transferred between generations over the next 10 to 15 years. It's already started and will continue. That's a big part of what I do in terms of, one, facilitating that transfer and assisting to planning for it. I won't say an old client, a client a few years ago who was a favorite client of mine, and he came into the office and he said, you know, people keep telling me I should have a will. And he had significant assets. And I said, well, you know, that's good advice. Everybody should have a will. He said, nope, not for me. He said, the day I die, my last check is going to bounce. And I laughed at him and I thought, what a creative estate plan. Get rid of it all. It's gone out of there. That's not what we're here to talk about today. We're here to talk about basically preserving our assets, looking at risk mitigation. Carleen has talked about risk mitigation today, and I want to talk about not just risk mitigation with respect to financial planning, but also risk mitigation with respect to life issues that have a big bearing on my wealth transfer, my beneficiaries, and my overall ability to deal with my own assets. So there's two things that when we look at an estate plan or an estate configuration, there's two things that we look at in terms of our assets. And Carleen's done a good job this morning basically describing two classes of assets. So in my world, my personal world, I may own a home jointly with a spouse. I may own bank accounts that are joint. I may own an RRIF or an RRSP where I have designated a beneficiary on it. I may own insurance policies that I've designated beneficiaries. And so those are assets that I usually put in a left-hand column, and I call them, those are my titled or designated assets. I own them with someone else, or I have designated someone else to receive them. So in the case of a TFSA, you know, the term is successor holder. Who's going to get that if I die? Those are joint or titled assets. And if I die first, before the person who I have titled with, those go automatically by operation of law. They don't go into my estate. They're not governed by my will. Those are all dealt with by operation of law. So one of the first things we do is draw up our left-hand column. What are those assets that we jointly own and or are designated and will go automatically? The other column is those assets that I own in my name alone. So I don't own them with anybody else. Those are the assets that basically comprise what I will call my will estate. So first of all, if I survive the person that I own the joint assets with or designated, those will all flow to me. And then those will now, because I'm the sole owner of those, they comprise additional assets to what I already owned in my own name. That will be what I call my will estate. So when I'm looking at that, it's important to look at both of those columns, if you will, because the totality of those two columns will be what you normally would call your entire estate. Those are the assets that that you're going to have. So when we talk a little bit about our will, there's a couple of things that we should consider. One, Carleen said when she started out this morning, she said, you know, what happens if you don't have an estate plan? Well, if you don't have an estate plan, you're probably going to be financially disadvantaged. There's no question about that. What happens if you don't have a will? Well, everyone has a will. I'm not going to ask how many of you have a will, because the national averages are that about 52% of people do not have a will. Right? So they have no means of transferring their assets according to their wishes. Now, if I don't have a will, I do have a will. The province makes one for me. And whether I like it or not, if I don't have a will, the province says they're going to distribute the assets for me. They're not going to take them, all right, but they're going to set up a scheme of distribution that will allow those assets to be distributed. And the way it works, basically, if I had a spouse and was married, and married spouse in terms of being married, my spouse would get the first $350,000. She would share any balance equally with my children. Now, the disadvantage of this, and we see this on occasion, is that a family, a young family, may not have a will. And if the wage earner, say the husband dies, it's not always the husband that's the wage earner, don't get me wrong. But let me give, as an example, if that was the case, the spouse would get the first $350,000. And if there are children, especially young children, that needed that financial support, that's the extent of what she would get under the estate, unless she shares the balance. Most often, surviving spouses with young children need every asset they can get to keep the children, to support the children. The children's share, if they're under the age of 18, when the government makes your will, the children's share goes and is held by the Office of the Children's Lawyer in Toronto. It belongs to the children, but until they're 18, they're not entitled to receive the capital. They can have access to income from those funds, and the government does a good job of income. But you can imagine a period of time when that family would not have access to the assets of the estate for the purpose of continuing to live. So that's the will the government makes for you. Preferably, you will make your own will. And your will support a spouse, it will give to adult children, it'll do any number of things. And in the course of making that will, as Carleen said this morning, you'll have the opportunity to be tax efficient. There are ways in terms of doing your of your will. Carleen also mentioned this morning, she was talking about this process of probate. And one of the pages that is in the material that I've left, and I think it may be up there, I don't know. Right. So there's a page in there called the myth list, if you get to the back. It's not numbered, you know, they don't. But if you get to the myth list, and I may speak to this for a moment, because I developed this list as a result of the questions I get from people who come to my office to see me, and they tell me what the law is. So one of the great myths is that probate will erode my estate. Now, how many of you, if I asked you honestly, how many of you would know what probate is? Not too many hands. So there's the myth. Probate will erode my estate. Well, let me tell you what probate is. So if I died today, all right, and I have an estate, assets, let's assume that I have a house, I have an investment portfolio of, say, $200,000 with the Bank of Montreal. I've got a vehicle. and other assets, a RIF, that type of thing. So I die, my executors, who let's say are my children in this case, or two of my children are my executors. Now I've made a will. My wife is deceased, so everything's to go to my children at this point in my life. My executors take a death certificate. I'm dead. They take a death certificate and they take my will and they go over to the bank and they say, all right, Dad's gone. Here we are named the executors in the will. And here's our identification. Give us the $200,000 investment portfolio. The bank says, not so fast, not so fast. So my executors asked the bank, well, what do you want us to do? And the bank says, we want you to be validated as the executors of the will. We want proof that you are the executors. They say, well, there's my identification. There's the will. What more do you need? The bank says, we want you to have the benefit of a court order that says to all of the entire world that you can now deal with my executors as the estate trustees. So how do we do that? Well, generally you would go to a lawyer. The lawyer would complete an application to the Superior Court in Ontario to receive what's called a certificate of appointment of estate trustee. This great long name they gave it. The probate court in England, common law, the probate court was the court that dealt with deceased persons and their property. It goes back hundreds of years. We've always used the name probate, you know, and we still do, but it's got this fancy new name now, certificate of appointment. So my executors go to the lawyer totals up all the assets, he fills out the application for the court, the will goes with it, and it goes to be presented to a judge of the Superior Court. And the judge looks at the will, he sees that it's properly witnessed, he sees that there are no objectionable things of public policy in it. They do a search throughout Ontario and to realize that this is the last will, and then they issue this certificate. Issuing a certificate is a court order. The effect of that court order that we used to call a grant of probate basically says to all the world, you can now deal with Bill's executors in terms of his assets and dealing with them. That's what probate is. It's a validation of the executors of an estate to be able to deal with the assets. So for example, if I was buying a house from an estate, I would want to know that the people signing the deed are the right people. So I'm only going to accept a deed from executors who have been granted a certificate of probate. But in this case, my executors, they take the grant of probate or the certificate, they walk across to the bank, they hand it to the bank, and the bank says, great, here's your money, and they hand over the $200,000. What's in it for the bank? What's in it for the bank is that the bank is now off the hook. They have given the money to the right people because the court has said these are the right people. And that's what probate is. So depending on what your assets are and the type of assets, you may or may not need to probate an estate. But generally speaking, if you had more than $100,000 in assets with any financial institution or group of financial institutions, they're going to require that you get probate. Now, will probate erode my estate? Well, two things. One, Carleen talked this morning about time. In Peterborough, prior to COVID, we were getting our court orders in 4 to 6 weeks. If you were in Toronto and died in Toronto, it would take you 11 to 12 months. Currently, 14 months to get a court order in Toronto to sell a condominium if you needed it. So that's one, when we talk about eroding estate, it's in terms of time. We went through 4 to 6 months during COVID. We're now back to 4 to 6 weeks. So it's not a long period of time to get that court order. There is a small financial cost. And the small financial cost is a percentage of the assets under administration. And basically, it's 1.5% of the value of the assets. In easy terms, on $1 million estate, the probate fees would be $15,000. I've had people come into my office and tell me that the probate fees are 20% in Ontario. You know, it's 1.5%. So when you're estate planning, sometimes we get advice from financial institutions, other sources, that you have to avoid probate at all costs. Whatever you do, avoid probate. Well, I'll give you a little story about how you avoid probate. So 10 years ago, one of my clients named Bonnie calls me, or not Bonnie, but her mother calls me and said, Bill, you'll never guess what I've done. That's a question lawyers like to hear right at the outset, as you can appreciate. I said, no, what have you done? She said, well, I was at the bank yesterday, and the bank told me that I have to avoid probate at all costs. Did they tell you how to do that? Yes, they did. What did they tell you? They said that I should put my portfolio, my investment portfolio, that I should name Bonnie with me as a co-owner. You remember I talked at the outset about the left-hand column, joint ownership, designation of beneficiaries, those assets that go automatically by law and not fall through my estate. So I said, so what did they tell you? And they said, well, they said I should put Bonnie on with my portfolio. And I said, well, that means Bonnie's essentially a co-owner with you. And if you die before, you know, she does, those assets are going to be hers. She said, that's all right. I know Bonnie would do the right thing. I said, but you have 4 children, and I know your will says it's to be divided between the 4 children. She said, yes, but I know Bonnie would do the right thing. So then I said, what happens if Bonnie is in a vehicle accident and becomes incapable? What if she has dementia? What if she has a matrimonial difficulty with a spouse? What if she has a business failure? And I went down through the litany of things that could happen with Bonnie being her co-owner. And so anyway, short and sweet of it all, next day, back to the bank, takes Bonnie with her, reverses it all, and said, that's it. Because the one thing I had said to her was, I said, you know, when you join someone with you in ownership, you, to a certain extent, are going to lose some control of your financial independence. And that was what really tipped her over the top. She did not want to be taking Bonnie to the bank every time she wanted to do something. She did not want to be getting into tax issues where who pays the tax, Bonnie or her. So there were a whole number of reasons why she was going to avoid paying probate and trying to do it through this concept of joint ownership. I said to her, I said, how much do you think the probate fees are? She said, I don't know. I said, well, in your case, $500,000, they're $7,500, and you don't have to write the check because the check comes after we're gone. I said, the 4 children will each bear part of that in terms of about $1,250 that they will not get because the probate fees will be about $7,500. In any event, those things, she went back, changed it all back. And the point I'm making is that it's not, there are times when we want assets to be owned jointly, and to use one of the vehicles that Carleen described this morning, where we can put them in joint ownership. There are times it makes sense, and as a consequence, you may well avoid probate fees. But we see many situations where in trying to avoid that probate fee, people mess things up terribly. So every situation is different, and it's important that you evaluate it and have advice as to what I should be holding jointly, what I should have in my own estate, and what I want to have governed by my will. So my answer to it, does probate erode my estate? No. It's a cost. It's like a tax. It's not a CRA tax. The probate fee that we pay is to the Ontario government, not the federal government. So, I wanted to just talk about taxes. I see it's on my list of things I'm to talk about. 1971, up until 1971, as a Commonwealth country, we had what I will call traditional death taxes. So death taxes were an estate tax. So that was a tax on the value of the estate. So if I died and had $100,000, my estate tax might be $5,000. Then the $95,000 would go to my beneficiaries, and they would be imposed a tax called a succession duty. So a succession tax is one that's paid by the recipients of that. And the third one was called a gift tax. And a gift tax basically said any gifts you've made in the previous 5 years to children, you have to bring back into the estate for computation of that. Those were traditional death taxes. 1971, the Canadian government got rid of them all. Said, that's it, no more traditional death taxes. There are two tax incidents that affect us when we die. One is this concept that we were talking about, a registered retirement savings plan, or at 71 when it's converted into a registered retirement income fund. So if I died tomorrow and had $200,000 in either an RRSP or a RIF, it doesn't matter, and I didn't have a spouse to pass it on to, all right, I can pass my RSP or RIF to a spouse and it's deferred, the tax is deferred. But if I didn't have that, then what the government says is that all of the remaining balance becomes income in the year in which I die. So if my normal income in the year in which I die was 50% or $50,000, and I had $200,000 left in my RRSP or RIF, my income for the year in which I die is now $250,000. And I will pay, as Carleen said this morning, 53% of that, right? So that was where the comment, when we talked about charitable giving is a very, very useful device to offset that tax. So basically, I often say to people, I can keep most of that tax in, or a big part of it, in Peterborough, philanthropic, projects in Peterborough, or I can send it to Ottawa. Who do I trust? Well, I'll leave that with you. The second tax that we have is the imposition of capital gains. And as been mentioned this morning, we have some exempt properties. So what's a capital gain? Again, let me take my tax portfolio that in my estate. So it started out, it cost me $100,000 of tax paid income to make the investments that are now worth $200,000. Right? So the day I die, as Carleen mentioned this morning, Canada Revenue says, Bill, your estate, sold those assets. In fact, they deem it sold the day before I die. In any event, so on the day I die, they're worth $200,000. I haven't sold them, but that's what they're worth. And we know that from stock portfolio records. They're easy to get. The gain between what I paid for that portfolio of $100,000 or contributed and what it was worth the day I died is $200,000 or is $100,000. 100 cost, 200 proceeds when sold. The capital gain is $100,000. The government says you'll take 50% of the gain and add it to your income for the year in which you die. So half the gain is $50,000. My normal income was $50,000. So they add that 50 to my normal income, and now my income is $100,000 for the year. I didn't count in the RRSP that got added, but if I took all of it, it would be even more. Again, you're looking at a very significant tax bill. But those are the only two tax incidents that we have when we die. So we don't have what are called traditional death taxes. But let me give you an example of how they differ. I'm going to give you two $500,000 estates. One is comprised of GICs, right? So I've saved all my money, I put it in GICs, they grow, but there's no capital appreciation, right? So $100,000 GIC is $100,000. It's going to provide some income on which I'll pay tax, but the principal will never be more than $100,000, and I paid for it with tax paid money. So $500,000 of GICs. Then I have another estate that has a cottage, and the cottage was given to the owner. So zero cost. On the date of death, it's worth $500,000. It's an exempt, or it's not an exempt property. It's not like my home that they don't charge capital gains on. This is a secondary property. It's a cottage, $500,000. The capital gain, $500,000. It was a gift, all right? And it's worth $500,000. Half of that becomes income in my estate. So $250,000 of income is added to my estate, even though I haven't sold the cottage. So I'm going to pay probably $170,000 in tax. My estate will pay $170,000 tax. There's two estates, both with $500,000 assets, right? One's going to pay about $170,000 in tax. The other's going to pay nothing. So the point is that what we call death taxes, or what we're looking at, is really a question of the type of asset and the amount of the asset. But they can be the same amounts and have completely different tax consequences. So every situation has to be looked at. And one of the propensities we see is that as people age, we tend to get out of capital appreciating assets and more so into income producing assets that don't have a capital appreciation. So if you want to avoid capital gains tax, which is our estate tax, you get out of capital property, or you liquidate it over a period of time and gradually get down to those types of assets that are income producing but not capital appreciation. So when you reduce the extent of your capital properties, that's the consequence. There's lots of things I could talk about in terms of wills. Just a couple of things. When you're doing your will, the most important consideration, in my view, is who you choose as your executor or your executors. In the mid-90s, they changed the terminology. We probably all know or recognize the term executor, because the executor is the person that stands in my shoes when I'm not here. They're going to look after my assets. They're going to steward them. They're going to follow the instructions of my will. And that's my executor or executors. So the term they now use is called estate trustee. You may see that term used interchangeably with executor. For our purposes, we should think of them as one and the same thing. This is the person in my testamentary instrument that I'm going to ask to look after my affairs, pay the taxes, distribute the assets, and settle any other issues that I need. It's probably the most important decision anybody will make in terms of making a will. We see lots of things. We see people who appoint the first son. Well, why would you do that? Well, that's traditional. My father did that. My great-grandfather did that. We always appoint the first son. We may have a situation where a family of 4 children and they all get named. Why did you do that? I didn't want to insult anybody. Got to keep the peace. And that's what we do. In those situations, I always ask the question, how do they get along? And sometimes I have to delve into that a little more deeply. And it's surprising how many parents sometimes will say, oh, they get along. I mean, they are siblings, you have to understand that there is the odd difference. They say, how do they really get along? If you had an estate question and you put the 4 of them around the table, are you going to get a consensual, position out of this, or aren't you? And if you're not, then you need to consider change. So if you do, if you don't do what is the typical thing, make sure you discuss it with your family. You know, who should be the executors? Who wants to do it? I know people who've been appointed, didn't know they'd been appointed and wanted nothing to do with it. You know, that doesn't help the process. So it's one of the most important things that you can do. And I really advocate sometimes for what I'll call the family discussion. Have that discussion with family and say, who should be, you know, taking on this? Who wants to? All right. There's lots of roles to go around. The other thing that I'll just mention briefly here and then finish has to do with powers of attorney. So the three components in my world that when we're doing estate planning and administration is that everyone should have a will, everyone should have powers of attorney. So what are powers of attorney? Well, a lot of people think that it's a lawyer doing something for somebody. The term attorney in Canada is used as it donates an agency relationship. So if I'm named a power of attorney, it's not because I'm a lawyer. It's because I'm a person who is now going to have certain authorities delegated to me to be able to act on someone else. Attorney is a US television term, all right? We don't use it in Canada at all in terms of the legal profession. And there's quite often a misunderstanding about that. But a power of attorney is a person who's appointed to undertake activities, functions for someone else. There's two types of powers of attorney. One is called a power of attorney for property. Property is a misnomer because everyone thinks of real estate when you think of property, but it's not property. It could be property. But basically, a power of attorney for property deals with financial assets and the management, stewardship, and distribution of those assets. The second power of attorney is power of attorney for personal care. It has nothing to do with money whatsoever. I couldn't sign a contract or do any of the things that the power of attorney for property can do on my behalf. But who makes decisions for me when I'm incapable of making a decision about myself, where I live, what prescriptions, who my doctor is, all those personal questions that relate to my well-being when I am incapable of making a decision on my own account. That's when my power of attorney for personal care has authority to make those decisions for me. So for example, how the two would work, I have an operation, I suffer a stroke during the operation, the doctors say Bill can't go home. He has to go to a facility that's going to provide care. And they ask me, can I make the decision where I'd like to go? I've had a stroke and I'm incapable of making that decision. My personal care power of attorney is the one that says where I'm going to go. Canterbury, Empress, Extendicare, wherever. It's my personal care power of attorney that makes that decision. Who pays the bills? My power of attorney for property, all right? And that's just an example of how the two work. But it's essential that you have both of those. And again, the same considerations apply in terms of who you would choose to do that. It's funny for me, a lot of choices for personal care powers of attorney for both men and women are daughters. It's surprising. For financial affairs, it's both daughters and sons. But predominantly for personal care, it's daughters. I have two daughters, so I understand to a certain extent. But it's important to speak with those people, have an understanding of what powers of attorney can do. What are best practices? You know, some people get to be appointed power of attorney and they say, I've been appointed, it's my way or the highway. No, I'm not going to tell you anything that's going on, you know. And in cases like that, that just leads to family dissension. So again, look at family dynamics, how it works and pick the right people to do it. I think I'll finish there. I think I'm probably over, but if there are a couple of questions, I'd be glad to answer them. I'm sorry if if I name a beneficiary. Yeah, like for an insurance policy, if I name a beneficiary, then just a death certificate and proof of claim. That's it. If I have a joint bank account, the successor, the person that survived me would just go into the bank with a copy of the death certificate. They would take my name off the account and leave it on the joint owner. So all of those category of assets that are like that are dealt with very simply, very simply.
When there is that second property,
I'm sorry?
when there is property, is it, did you suggest to put it in your name plus the kids' names, like, so that's in the city?
Yeah, I mean, it's that. Yeah, so the question was where there are two properties. Would I suggest putting one of the properties in the children's names with me, for example? I think that was the gist of the question. So as I explained, I'm a little guarded always about putting property in the children's names. Now I shouldn't say I'm guarded about it because I've done it, but again, I would look at the relationships. And if I had 3 children, for example, and this was a recreational piece of property, let's say it's a cottage, would I put the property at this point in all 3 names with me so that if I died, they automatically become the owners and no probate, nothing like that? Would I do that? I would, if I'm satisfied that the 3 of them can get along, that it's not going to, that split division of property is not going to cause difficulties between them. Yes, I would look at that, but there's a cost. If I gift a second property, a lot of people will ask and they'll say, we have a cottage or we have a farm property or a recreational property. I want to gift it to my children. That's how I'm going to avoid probate and I'm going to avoid capital gains. I'm gifting my property to my children. Well, the difficulty is that the minute I gift it to my children, and I won't be getting any money back, Canada Revenue says, whoa, not so fast. The day you gift it, you're deemed to have sold it. So capital gains becomes exigible that day. I've got to pay I now have to pay the capital gains because the children have said they don't want to pay that, so I have to pay it. Then they can have the gift. That's fine. But it comes with a tax consequence in terms of gifting. Yeah. Steve. Yes, they are. Yeah.
Just repeat the question.
Well, the question was, is a gift different than putting another person's name on a title or an asset, right? So one is succession, all right? Gifting is succession, but with a tax consequence. Yes. That's a good question. So the question is if your relationship is a partner relationship and not a marriage relationship. So in Ontario, briefly, people who are common law or partners, and common law is the term that people generally use for 2 people living together. you acquire no property rights. All right. So if you're not married and you lived in a property that was owned by a spouse and you separate, you don't have the property right that you would have if you were married. Now, having said that, so in Ontario, basically, if you're not married, you don't acquire the same rights to property that you would have if you were married. Having said that, the definition of spouse is quite different for different things. So years ago, we would think of a spouse as one who was married. The term spouse has been broadly expanded, and depending on what legislation you're looking at, it may or may not apply. So, for example, someone who is not married, but has been living in a conjugal relationship for more than a year, for example, will fall under the definition of spouse in that legislation. So, Canada pension sharing, there are a number of things that people will share in, even though they're not married, by virtue of the definition of spouse. And the spouse is not, it's not a standard definition across all circumstances, so you have to look at that. But the basic question, do I acquire property rights? And the answer is no, if I'm not married. If you're in Quebec, completely different. Yes. Mm-hmm.
Right to see that.
If you are what I'll call a residual beneficiary. So there are two classes of beneficiary in a will. There's the beneficiary who receives a specific bequest or legacy. So to give you an example, I'm given $5,000 in the will. I'm entitled to see the provision in the will that says I get $5,000. If I am a residual beneficiary, so that would be the class of beneficiaries who share the assets of the estate after all the bills are paid, all the taxes paid. What's left is called the residue. And after all the bills are paid, those who share the residual assets are entitled to see the entire will. Yeah.
Can you just talk a bit about involving charitable gifts in the will and how to balance that with the tax implications? So, you know, you could say you're going to pay X amount of tax, you want to reduce that by making a charitable gift.
Mm-hmm.
But you're using that as a strategy to kind of make sure there's lots left for the dual benefits, you know, children or whatever.
Right.
And so kind of the more you give to the charity, the less tax you pay, but the less there's available to your how you see your clients
Right.
matter deciding on what kind of portion to designate to a charity for that purpose.
Yeah, I guess the one way, I think Carleen and I would both probably agree that the year of death is your best year for philanthropic, for the tax efficiency of philanthropy. So, and that's why many people will, you know, leave their philanthropy until they die, because it's probably the most tax efficient year. You can reverse in what I call reverse engineering that question of, do I want to pay tax or do I want to, you know, have philanthropy? So very simply, and again, you would do this with someone like Carleen, and you would say, what does it look like if I died tomorrow? What does my tax bill look like? All right, that would be my RIF comes in, capital property comes in. What's my estate looking at in terms of a tax bill if I died tomorrow? So then you would say, how I have these philanthropic interests that I've always had. How much money would I have to give to them in the year of my death to offset some or all of what I have the anticipated tax bill if I die? So that's reverse engineering, all right? And you can, you know, a lot of people do this on every couple of years, they'll look at this and they'll adjust it. And they say, well, I can now give more money to this because, you know, the tax bill is going to be that. So that's how I approach it generally. And again, you know, you would use a financial advisor to go through the calculations and see what it looks like made these gifts, as opposed to if I didn't make these gifts, given my assumed tax liability. Does that answer the question? Okay. I'm going to have to leave, Paris. I'm sorry if that's okay. I could take one more question if there was one more, perhaps.
Zoom here.
Okay, sorry.
So Janine, can you unmute and ask the question?
Sure, yeah. Can you hear me okay?
Yes.
Okay. So the question from one of our Zoom participants was, if there is a grandparent who is the subscriber on an RESP for a grandchild, and that grandparent dies, does there need to be another designated subscriber for it to continue with the same beneficiary in mind?
Maybe Carleen,
Yeah,
you can
that's
answer
my
that. Yeah.
Okay, so a grandmother was a subscriber and they passed away, is what you're saying? Do they need to have?
It looks
Um,
like that's what the question is from one of our participants, yeah.
Okay, so that's a question that they would need to deal with me in specifically, because generally, if you were a subscriber that had an RESP and then that person died, we have to go to the financial institution and go through the steps. They have their own process that they want to have in place. There's forms they have to sign, unless if they want to have somebody replace them. Or like, we just have to go through the financial institution and walk them through that.
Okay, thank
Quite
you.
often, in a will, we will quite often authorize the executors to contribute,
Right.
to continue the contributions to RESPs.
Right.
So if there's the intention that the estate continue to do that, we'll put that in the will as an authorization.
This sounds like it's more of a specific scenario, but when we are CSPs, we can set it up that there is an alternate person that should something happen, somebody else would replace them, and that's part of the planning. But if this is specific and they need help to, then we would just contact me and I can help walk through.
That's great. Thank you. And just some feedback from the same participant for Bill, just saying thank you. That was an excellent explanation of the probate process. Much
Good.
appreciated.
Thank you so much, everyone,
Thank you.
for joining. We'll send out a feedback survey if you don't mind filling that out, and I will send the slides and the handout that Bill has, and also the recording of this workshop. Thank you.